Welcome back to another episode of the Startup Therapy Podcast. This is Ryan-Rutan, joined as always by Wil Schroter, my friend, the founder and CEO of startups.com. Will, we talk to lots of founders. That is no secret around here. And one of the things that we talk to them about a lot is seeking investment. And within that conversation, one of the things that often comes up is what is going on with the investors? What are their motivations? What are they trying to do to me as opposed to for me? Are they trying to shove me off a cliff? What's actually going on here?
You know, the funny thing is, kind of.
Yeah.
They kind of are. I mean, and like the funny thing is, and what we're going to talk about in this episode, with good reason, right?
Yeah.
Like their motivations are to push us off of a cliff. Now,
Yep.
that sounds dire, right?
Yeah.
That sounds dire when you say, oh my God, they're pushing us off a cliff. But if you really understand why they're doing it, I'm not saying I agree with it, by the way,
Yeah.
but I understand why they do it.
Yep.
And we're going to talk about that. We're going to talk about why they're doing it, why they can do it. Works for them, doesn't work for us, right? And those two things don't sync up. So people understand the motivations. So I think let's start there. Let's talk about what the investors' motivations are to push us off a cliff as a startup.
Let's start with the fact that investors aren't just betting on us as founders. They're racing against their own clock, right? I mean, I think this is one that we forget about, but we look at Andreessen Horowitz, for example. They raised what, $1 billion funds.
Oh, it's crazy. Yeah, it's crazy.
10-year time frame they got to return that money on. They spend a couple of years making the investments, and then they've got a few short years to kick everybody across the line and try to drive a return for the partners, right?
It's crazy, yeah. And so essentially, though, if you're one of the limited partners, and for folks that don't understand this stuff, limited partners are the folks that fund VCs. They are the money behind the VCs. The deal goes, when you're out raising, if you're a VC and you're out raising a fund, the deal goes like this. You're going to give me a bunch of money, millions, in some cases, billions of dollars, like totally, in order for me to invest that in a very relatively short period of time, in less than 10 years. But the big deal is, if this works on a 10-year horizon, I'm going to give you way more money than you could have ever made in the traditional markets or anywhere else. That's the bet. But that comes with a really specific timeline, which is I have to make this bet, all these bets, as the VC, in a very short period of time. And all of those bets have to turn into returns in an even shorter period of time. Ryan, if we were to play it out, how long would you figure, like if you and I just raised a fund and we said we're going to return all this money and more in 10 years, how much time do you think we have to make those bets, just making the bets before they do anything?
Well, I mean, there's always going to be some rate limiting factor there in terms of the number of qualified deals that we find and getting to terms and all that stuff. I'd say like 3 to 4 years, probably on average, just to get the capital deployed.
Let's talk about that. Let's pause there. Now, it's Ryan and Wil VC. We've never talked about us being the VCs, but let's put our
Hang on, I've got a monocle around here somewhere. No,
yeah.
Best I can do is some fighter glasses.
Yeah, you need a Patagonia vest, and you need in khakis. And so we've raised a bunch of money. At first, we're in a mad rush to deploy that money so that we can get those companies scaled up as fast as possible, so that we can exit all of those returns. Couple examples. One of our investment portfolio companies comes to us and says, hey, good news. I don't need any more money. I think we can grow this thing about 20% a year and it'll be profitable every year. And we're like, that's terrible.
Yeah.
But why? Ryan, when people talk to you about this, like, hey, I think I'm going to make a company profitable, it isn't that great. Profit's not bad, right?
Right.
But how do you see it from the VC side? Like, how do they view that same answer?
Easy. I look at profit as a missed opportunity for growth.
Yep. Yeah. Great.
That's it. Great. Right. That is, you are sitting on money. You are hoarding cash that should have been deployed to make this thing grow fast at the cost of profitability, at the cost of stability, at all those things, because that's what I need. Right. As Ryan, the VC, I need you to not be sitting on money that you can send out in disbursements to other shareholders, to anybody. This has to be redeployed as growth, so we can hit the next funding round, so we can hit the next funding round and the next funding round, and then either get acquired or go public, which is how I get paid. And that's all I care about.
So you and I, as the VCs in this case, we have a very specific time commitment. Like we can't take our time. We can't hope this thing becomes profitable someday. Right. We have to grow as fast as possible to get to one of two specific outcomes, either a sale or an IPO.
Stick on that, because we're fighting a very narrow time window.
Yep.
And we're fighting a very narrow outcome window. We can't just become a profitable company that pukes cash, because that doesn't benefit the investors. So not only are we fighting the clock, we're fighting against the fact that now we've narrowed down our victory lane significantly.
You bet. And so I think it's important to initially understand why the investors are pushing us off a cliff. Again, we're going to get into more parts of this, but initially you've got to understand where their motivations are coming from.
Sure.
Their motivations are very specific. I've got a limited window. I've got to get this thing to a big exit fast. And you know what I can't afford? Time.
Yeah.
I can't afford time. So I need you to spend every bit of that money right now, hire as many people, do as much marketing as you can to get to an outcome, good or bad, really quickly. And so the other thing I want to ask is this. Do you think that they want us to run out of money? Right now, no, in other words, when investors say to us, hey, we want you to spend this as fast as possible, any rational founder is going to be like, oh, okay, but then we're going to run out of money. What does that make you think?
It's kind of the other side of that same coin that we just talked about, which is that profit looks like lost growth opportunity, right?
Yep.
So it's not that not that I want you to run out of money, but I certainly don't want to see you accumulating it. And I want to see you spending it all the ways that will make you move as fast as possible. Again, like the time horizon here is so short. If we've got 10 years and we said we're going to spend the first 3 to 4 and maybe more deploying that capital, and we know that it takes 7 to 10 years for most startup companies to hit the type of outcomes that we're talking about.
Absolutely.
They're literally like, it is photo finish time.
Yep.
And so any cash that's retained in the company is not being used in a way that's going to help accelerate that growth. Now, you can make all kinds of arguments around like, oh, well, but then if you hit a trough, you hit a plateau, you hit something, and if you got that cash, then you can break through it. Sure, maybe, but that's not the way this works. You've just got to keep pedal to the metal. It's got to be afterburners all the way, all the time.
So maybe we look at it like this. Investors don't want us to run out of money. That doesn't behoove them either, but they also don't want us to hold on to it either.
Nope.
Right?
Nope.
They want us deploying it as fast as possible so that we can grow as fast as possible. Now here's what I've heard from a fair number of founders, especially recently. They said, hey, if I raise $5 million at like current pace, I could like not need money for like 6 years.
Then you got to change your pace, man. That's the only answer. It's like, cool. I hope you've enjoyed first gear. That's the last time you'll see it for a long time. We're now in fifth gear and you're going to stay there even through the curves.
And so from the outside, when people look at how venture funded companies or funded companies are spending money, they don't get it. They're like, wait, this company just hired 100 people, 200 people, whatever. And then they look retroactively, they look at what happened to those companies when they flame out.
Yeah.
And they're like, didn't the investors see them spending all that money? And it's like, yeah, because the intention was that if we raise a bunch of money and we grow very quickly, that we're going to get to that big outcome faster. Now, here's what's funny. And we're going to spend a lot of time talking about how our worlds are not aligned between us and investors. Yeah. But one of them that I think is very clear is the investor needs an outcome as fast as possible. We would like one, but we just want to have an outcome and whatever timeline that takes. And once again, we are not aligned. The investor's like, I need you to burn through this money and grow as fast as possible to either make this work or not, so we're done. And we get sold on that argument so easily because here's how it's pitched to us. The pitch is this. Don't you want to grow as fast as possible? Don't you want to make this successful as fast as possible? So we're on the same side here. Yeah. And it's like, at first we are when there's actually money in the bank.
That's it. There it is right there.
And so I think for the most part, it's not that they want us to run out of money. It's that, yes, they don't want us to hold on to it. But more specifically, when they start saying spend that money, there's a narrative that they're trying to construct. And that narrative is growth. Yep. They want us to look like we're growing, even if we have no revenue to show for it, which is like 90% of startups.
Yeah. And it's tough because it is one of those cases where I don't really think that there is a middle ground, right? We can say like, okay, well, the startup founder, if this takes 7 years or 15 years, I don't necessarily care. If I'm enjoying running the business and we're making some money along the way and it's going well and we hit profitability and now I'm taking a little mini exit of $500,000 to $750,000 a year every year in distributions, feels great to me. right?
Yep.
And don't really care how long it takes. That doesn't work for VC at all, right? They're like, nope, we got to push this thing as fast as we can to get where we need to go, to get to an exit, to get to IPO, to get to whatever, big liquid exit in that probably 5 to 7 year time frame. And you go, okay, well, how do we meet in the middle? You don't, right? What is it you're so fond of saying? Well, she with the gold rules, right?
Yeah,
so when
the
you
golden
start
rule.
to take on other people's money, you also fully adopt their rule set. And that's just the way this goes. There is not a middle ground here.
There's not. Something that's really funny about everything we talk about here is that none of it is new. Everything you're dealing with right now has been done 1,000 times before you, which means the answer already exists. You may just not know it, but that's okay. That's kind of what we're here to do. We talk about this stuff on the show, but we actually solve these problems all day long at groups.startups.com. So if any of this sounds familiar, stop guessing about what to do. Let us just give you the answers to the test and be done with it. And so for the most part, when we think about this in terms of why are they pushing us to rip through cash, et cetera, you got to remember, they're doing it for a reason. It's not coming out of nowhere. It's not just, quote, bad advice. It winds up being bad advice when the thing fails. What they're thinking is, I'm going to make 20 bets.
Yep.
For each of those bets, I'm going to push them as hard and as fast as possible. And some number of those will flame out. And then we'll talk about that later.
Before we get there, let's talk. There's another really, really important factor to all of this in terms of the time frame and how long this takes or how fast it takes or how profitable you are or what the founder benefits along the way. And that's the fact that investors are going to get paid either way. We, the founders, are not. So before we jump into how many bets they're making versus how many bets we're making, let's talk about how those bets actually pay back. So let's stick to the VC because it's very different for angels, but they're also investing under a very different thesis. So we're mostly talking venture capital. So walk us through it, Will.
There's a few things we've got to remember. And again, this is one of those things where they're like, oh, we're on the same side of the table. Not even remotely close, right? Like only in the best possible outcome, right? Are you on the same side of the table?
On the same side of the
Every
table
other
the
part,
day we agreed to the terms. We might end up at the same side of the table the day it exits. Maybe not, depending on how far we've gotten squashed down the
100%.
cap table. But nary those two places shall meet. We will be on opposite sides of the table for that 7 to 10 years.
There's a couple things that I didn't know early in my career about how VC worked or how venture funds work. And
so they kind of rely on that.
Yeah. So for those that aren't familiar, venture capitalists, they raise a fund. And within that fund, the way they get paid is twofold. It's called a 2 and 20 model, usually. The 2% means for whatever we raise on this fund, let's say it's $1 billion, we're going to take 2% of that every single year for a decade.
That's
in salaries.
Salary.
In other words, even if the 20%, which is we're going to take off the profits if we ever get them, even before the 20%, we could be taking anywhere up to $200 million in fees over a 10-year period, right? For a big enough fund.
Yep.
Again, it's 2% every year.
Every single year.
That's a lot of money.
Whether we deploy the capital or not, whether we get any returns on the capital or not. Just keeps coming.
And we can operate this with 12 people. So again, we don't have massive overheads, et cetera. Those private jets aren't cheap though. So with that said, when we're talking about the difference in outcomes, as an investor, what's really sweet about my life is I'm going to get paid either way. Now, I know an awful lot of venture investors, and they don't all see it that way. They know it's true. They know it's true, but they don't all see it that way. And I remember a good friend of mine, I never named names on the show, but a good friend of mine who was a managing director of a great firm out on the West Coast. I remember having breakfast with him one day, and he said, I know this is, I'm not complaining because I'm in a privileged position. He said, but I've been at this for 10 years. I make a good salary, but I would have made a lot more money had I gone into investment banking or kind of anything else within the realm of what I do. And it's kind of the same discussion that we have with founders that are venture funded, right?
Yeah.
They're like,
I don't know, dude. That's kind of like saying yeah, my 120-foot yacht's nice, but had I done something else, I could have had a 150-foot yacht. Kind of goes screw.
I'll give it numbers. So he was making around $400,000 a year, right? Which again is a lot of money, right? Yeah. So I'm not, but not $4 million a year,
right?
I want to be clear. He wasn't complaining about that, right? It was a smaller fund relative to funds, but still a pretty healthy fund. What he was saying is he's in the prime income earning years of his life. He was like in his mid 40s, right? And he said, hey, in finance, in your mid 40s, you're making millions of dollars per year, right?
Yeah. You're
And
also not sitting at breakfast with me at that point. You're in the office. You're not wearing a Patagonia vest. You're wearing a tie, right? There's some trade-offs.
So, but what was interesting about it was VCs generally don't get, quote, into it for the salary, but they're going to get really well paid. So why does that really matter to us? Here's why it matters. Because we're going to get a salary and it's going to be nominal. It's, even if we raise $10 million, we're probably looking at $150,000 salary, maybe $175, depending. While we're basically still trying to figure out how to maintain bills in a $150 isn't what it used to be, right? I'm not going to get into this whole argument, but I'm just saying it's not the kind of money it used to be. That is for sure. And so at the same time, the person sitting across from us, the VC sitting across from us saying we're on the same side of the table, I was like, you make 10x what I make, right? I'm a rounding error in your personal budget, right? Yep. If this thing takes off, sure, I'll make more money than you will relative to me, hopefully having a bigger equity stake. But that's where it ends. Until then, if this thing doesn't work out, this salary is all I got. And if it does work out and we keep on moving, this salary is still all I've got. Yeah. And I wasn't getting paid for like the first 4 years. So if you average it out, we're not doing the same, not even remotely.
For them, it's a portfolio strategy, right?
Yep.
For us, it's our livelihood, right? Yep. This is what we are going to survive on or not, right? Depending on how things are going. Yeah, very different sides of a very different size and very differently set table.
Here's the big difference. For investors, they make multiple bets.
Yeah.
We have one.
Yep.
Now, that does not put us once again on the same side of the table, right? From an investor standpoint, they can afford to lose this bet. Yeah. It sucks. It's not what they're hoping for, but it's what they're planning for. They go into this saying, I'm going to make 20 bets. Hopefully 2 of them will work. Yeah. We go into this saying, I'm going to make 1 bet.
Right.
And if my bet doesn't work, I'm screwed.
Yeah.
Right. Yeah, we don't have 19 other opportunities to fall back on.
For them, we're a 1 in 20 shot. Right. For
Correct.
us, it's a once in a lifetime shot. This is it. This is what we got. This is what we're going for.
It's our everything. Yeah. We have 1 bet. We have 1 hand. Now, investors will tell you a different story, rightfully so. They'll be like, I treat every one of my investments like it's the winning hand. Okay, sure. But by default, it's not. that the difference between this company failing for you and for me as the founder is you're not going to lose your house.
Right.
I am. And when we talk about not just VCs, but angel investors 99% of the time are using their discretionary funding to put into this. So for them, it was, I didn't take another vacation, buy another jet, buy another house. I mean, it's kind of the same budget they would have used for that kind of stuff.
Right.
For us, it's, I have no house.
I have, yeah. It's involvement and commitment. And I remember this being explained to me once by a farmer. He said, look, if we want to think about involvement versus commitment, think about breakfast. The chicken is involved. The pig is committed.
Yeah.
Right. One of the two has everything on the line. The other one is like, okay, I'm here.
And it's funny how passionately the investors refute this, right? And again, they're all good people, and I'm glad they're in the environment. So this isn't like knocking investment. I'm just, it's a perspective thing. And they're like, you don't understand, this is my business. Companies failing or not is my business. So when a company fails, that does hurt me. It's not incidental because I've got other investments. And I'm like, I don't think you understand what I'm saying. I'm not saying it doesn't hurt you. I'm saying you'll get by, right? I won't. That is such a fundamental difference. It's like when the startup goes to sell for like a small amount, right? Yep. And the investor's like, I don't think it's worth selling. There you go. For you, it's not worth it because you already have money, or it's only going to make a small impact on your fund. But for me, as the founder, it's everything. It's my entire life.
So look, as founders, our journey with investors is a balancing act, a constant push and pull between the drive for exponential growth and the need for sustainable survival, right? Understanding their motivations and recognizing the differences in our relative stakes can help us work together, right? But it's up to us to set boundaries that protect our own path forward. In the end, finding success isn't about choosing one perspective over another. It's more about aligning where we can, advocating for what we need as founders, and then navigating the challenges with as much resilience and clarity as possible. Remember, this is our one shot. So let's make sure that we're building in a way that's worth all the risk that we as the founders are taking.
Overthinking your startup because you're going it alone? You don't have to, and honestly, you shouldn't, because instead, you can learn directly from peers who've been in your shoes. Connect with bootstrapped founders and the advisors helping them win in the Startups.com community. Check out the Startups.com community at www.startups.com to see if it's for you. Could be just the thing you need. I hope to see you inside.